Good afternoon. It's great to see everybody here. My name is Randy Sadler with CSC Services. I'm joined by my colleague, Chris Gallo. Today, we're talking about the challenge of I formed a captive, had a huge claim my first year, which is actually, you're going to see it's not a challenge, it's actually a huge win. Next slide. So want to remind everybody, keep your computer or your phone on mute unless you're asking a question. And if you have a question, that'd be great. We'll pause for questions. You can also type your questions in the chat. So I'll let Chris introduce himself, and then I'll introduce myself, and then we'll go from there. Chris, take it away.
Thank you very much, Randy. Yeah, Chris Gallo. I was a regulator with the Connecticut Insurance Department for 35 years before I joined the private sector and joined Randy Sandler's team. And the one major lesson I want to let the audience know, but I learned in a 35 regulatory career, was the critical importance of sustainable liquidity, cash flow, and earnings. And we're going to show you today how Captives helps business owners achieve those three goals.
Very good. Thank you, Chris. And this is my bio. Now, of course, we'll send you the slides if you ask for them, but my name is Randy Sadler. I'm a principal here at CSC Services. We are a captive manager. I've been here 11 years, and my background essentially is that I learned risk management in the Army, where I was a tank commander. And after quite a few corporate roles, joined CSC Services, really as our head of client education. So we're honored to be with you today. All right, a little bit about CSC Services. As I mentioned, we're a captive manager. We help successful businesses set up and own their own insurance company, which has many benefits. We'll speak to some of those today. And we really do all the following. We help businesses establish what we call asset protected loss reserves, and the ability to put away money to protect the business for a rainy day. Increase their profit and wealth, typically by millions of dollars over time. Lower control their insurance costs. Address commonly uninsured, underinsured risk. COVID was a classic where many businesses were interrupted and their commercial insurance did not pay. However, all of our captive clients that had a COVID loss, their captive paid for that loss. So we'll talk about that more, kind of exciting. And then obviously you have the chance to benefit from insurance company tax treatment. Yes, Chris.
I was going to say, all those 5 bullet points that Randy just mentioned, those are all items that increase business owners' wealth, their cash flow, and liquidity. Go ahead, Randy.
Yeah, very good points. Very good points. So a little bit more about us. We sued the IRS back in 2017 over a notice called 2016-66. The IRS, which frankly is discriminatory against small and middle-sized business owners. Nevertheless, the court sided with us. It went all the way to the Supreme Court, where we beat them 9-0. And so in September 21, we got an injunction against 2016-66, and by the following spring, their notice was vacated, which basically is essentially null and void. So we're very pleased to see courts doing the right thing, and we'll continue as a captive manager fight for the industry and also for the rights of business owners to protect their business and help their employees keep their jobs. I mean, that's really what it's all about. So we're also pleased to announce that we won Middle Market Captive Manager of the Year in 21 following the court victory, but we also won it this year in 23. Very excited about that. Really based on a lot of our innovative ideas that we've brought to the market to help clients protect their business. So very exciting. I'd love to share with you why we won it if you want to ask me about it. Okay, what is a captive insurance company? Now this is set up till we get to the meat of the content today, but got to have a little background to work with. A captive is a real insurance company. So the very same way that a business owner owns their business, they now own a new business. It's a captive insurance company. It receives a license to write insurance from normally a state regulator, right? And now they're able to protect their business. Captives have been around since the 50s, so they're not new. Now, what do? Well, interestingly, they do a lot. They can do everything you see on this page, individually or collectively. So they can replace commercial insurance. And many of our clients, their commercial insurance is sky high, and they decide to take that risk in a captive. They can insure what we call enterprise risks, which are commonly uninsured, underinsured, but very real, which we'll speak to those in a few slides. They can insure warranties, a great way to create found money and a profit center. They can do bonding. often done in construction and mining, and we've done that quite a bit. Helps keep money again, found money. They can also insure employee benefits and healthcare. If done correctly, we typically see 10 to 15% savings for our clients. And any combination of the above. So a captive could do several of these all at the same time.
Randy, one point.
Yes.
So when Randy talked about insurer warranties, from my regulatory days, I came to realize that warranty was like the second most profitable business in the insurance world behind title insurance. So we try to encourage all of our clients, if they manufacture anything or they have any type of service, we always try to explore where they can offer warranties for the things they manufacture or service, because it is a proven profit line for them as well.
Yeah, very good point. Very good point. I like that. All right, so let's get into the meat of our discussion today. I formed a captive and I had a huge claim my first year. Well, let's think about it. Many businesses face what we would call commonly uninsured, underinsured lines of risk, right? An example might be litigation. You might have a general liability policy, but you could get sued over something outside that policy. Happens all the time. Supply chain, huge, right? Many businesses aren't insured commercially for receivables, but if somebody doesn't pay, it's a big problem. Cyber is a huge one. In fact, I was just on a risk assessment call today with a business owner in manufacturing and distribution business that lost $1 million because their accounts payable got phished and wired the money to the wrong place. Think about that, $1 million gone, probably ended up somewhere in Russia. Never get that money back, right? So your captive can insure cyber. Fines, largely fines by the government, perhaps brought against you, administrative actions. Reputation damage. This is one that's very difficult to insure commercially, but it's very real. And so you can insure these in a captive as well. There's many others. Uninsured risk would be business interruption due to pandemic or just business interruption. And as we mentioned, many businesses were closed by the governments or other reasons during COVID, and they didn't get their business interruptions claims paid in the commercial market, but all of our clients that had a captive had their claims paid. I'm going to pause right there because we've got a question in the chat bar. All right. This is a long one. We all know the IRS hates captives despite the law and Congress. Example being treated as a listed transaction, possibly the number one reason why business clients don't sign up for a captive. If a client gets a captive and therefore attacked by the IRS, what is the client's legal recourse? Is there a master legal fund? Okay, good questions. Yeah, so it's a very good point. The IRS does hate captives. And that includes large and small, by the way. They happen to be discriminating against small captives now, but they do, in fact, discriminate against small and mid-sized captives more right now. That's what they're on the warpath against. However, we are starting to see them lose over and over. So, for example, we beat them in the U.S. Supreme Court 9-0, and we are continuing to push back on them as CIC Services. The industry is as well. And what we're also seeing, because 38 states license insurance companies, is we're seeing states start to push back as well. You may or may not know there have been many recent court cases where the IRS has, to avoid having a court ruling, they've settled for nothing. So the one called Puglisi Egg Farm, where the IRS was about to lose. They knew they were going to lose, so they settled for basically, nothing. And since that time, there have been well over 30 cases where the IRS has settled for $1. And these were insurance companies making the 831B tax election and electing to protect their business. So yes, there is a risk of being audited. And so a business owner has to make a smart business decision. Do I want to protect my business against all the uncertainties? Or am I going to let the IRS bully me out of following the law that Congress has already provided, and then accepting a state regulator's decision to approve my captive, and then am I going to let them bully me out of protecting my business? And if the answer is yes, then that's okay. Maybe the climate will change, and then you have a captive later. But I can tell you this: I know a lot of business owners that were bullied out of having a captive. They really wish they had it during COVID, and so whatever the crisis may be, a business owner has to ask that question. Am I willing to battle the IRS to protect my business?
Randy,
Yep, go ahead.
everything stated was true. The other thing I might add is that how critical it is to set up the captive the correct way. You have to have legitimate insurable risks. So CIC Services really prides themselves in making sure that it is a legitimate insurance company and they are insuring legitimate insurable risks as well. So very critical that you set up the captive for the right reasons, which CIC Services.
Yes, that's right. Yeah, very good points, Chris. It's important that a captive be set up to provide risk management to help the business survive. And then obviously it's important that all the components be done correctly. So the underwriting be done professionally. We have solid actuary pricing. And one of the reasons that we encourage our clients to use onshore US regulators is that they do take a hard look at the captive, its structure, its policies, the actuary work done. And so it's great to have that US regulator seal of approval on your captive as well. We really like that. So we've got a comment. Thanks much for the detailed reply. Oh, thank you. Yeah. And then we've also got a note saying IRS doesn't like inappropriately operated captives. Okay. Well, that there certainly have been some places where there's abuse. And so, we would be remiss if we suggested that every single captive, that small or large, was operated perfectly, right? There may be clear instances of abuse. It's very important that if you do decide to own your own insurance company to protect your business, that you don't abuse the rules. And one of the great ways to do that is to really work with a US regulator and lean on them to really look hard at the captive structure and all the things that it's doing. That helps a lot. Okay, very good. Let's keep going. I'm getting some good questions early, right? So one of the things that we want to stress, for some reason my mouse is bouncing around, is that captive insurance works. Now you can go read this article. This is in Captive International. There is Sean King, attorney, CPA. He's a principal in our firm. He notes that captive insureds were often able to get claims paid and approved far more quickly, which is true. Right now, there is a trend in commercial insurance to really drag their feet and not pay claims. And if you ask for the slides, there's a link to this article that was published a while back by Sean and Jana Patel. And we had several cases. All of them had their claims were paid by their captive during COVID. Trucking company that had their routes canceled, ophthalmology practice that was deemed non-essential, pediatric dentistry, again, non-essential. And their employees had to be paid. Even if they had the PPP loan, they still had rent, they had all their other bills. And then we had a group of employee performance consultants. All their events got canceled. And so the captive let them keep their employees when all their competitors basically having to let people go. So they were able to get back on their feet very fast and then thrive coming out of COVID. So very important. So you'll notice that, Jana Patel says none of CIC Services clients who had a COVID-19 related loss went out of business. Now, out of 150 insurance companies, that's 150 small, mid-sized businesses. Those are amazing odds, right? 0 out of 150 going out of business during COVID, that defied the odds of the rest of the US. All right. So consider small, mid-sized businesses are fragile, right? They're vulnerable to many things, but they're often geographically concentrated, often have lack of access to capital markets, usually have revenue stream concentrations. And for this reason, a lot of small, mid-sized businesses really don't survive a huge hit, whether it be natural or human disaster. And even our own federal government encourages businesses to be ready for the unexpected. And this is their chart, not mine. This is from ready.gov. And it lists a lot of hazards that businesses really aren't prepared for or need to be prepared for. Some of them may be insured commercially, but if you look at this huge list, you'll realize it's impossible to insure all of these commercially, right? So that brings us to a discussion about enterprise risk captives, which is going to really parlay into our discussion about having a large claim your very first year, which many of our clients have, by the way. All right, so enterprise risk management is really a discipline where any company or organization assesses all the risks they have from all sources with the goal of creating value for their stakeholders by being able to address all those risks, right? And so when we think about risk sort of in 3 buckets. You could probably come up with more, but let's go with these 3. So core risks are risks typically where you have to have insurance because somebody makes you, right? So you have to have work comp because the state makes you have work comp. You have to have auto liability because the state makes you have auto liability. And if you have a bank loan, you have to have property, right? Those are some really obvious ones. But then outside of risks where we're required to have coverage, we have operational and strategic risks. Operational are risks inside of your business, and strategic risks are outside your business. And I think what we've seen through the years is very often common insurance policies purchased in the commercial market just don't cover all of these, and they don't cover them very well in many cases. So, Chris, tell us about some of these commonly uninsured, underinsured risks.
Exactly. So we talked about pandemic disease. So in Ready.gov, they said back in 2015 that these are the risks that businesses should insure themselves. So pandemic disease, like for COVID-19, it's a 1 in 100 year event. You really can't go to the carrier market and say, I want business interruption caused by a pandemic. Also, like broad form property. That's where I found as a regulator, the traditional insurance companies, their language is very tight. There's many restrictions and many exclusions. So broad form property is something you would say, hey, fill in the gaps what our commercial carriers policies do not cover. Regulatory and legislative changes. For example, say if all of a sudden they do away with oil, they say you can't extract oil from the ground anymore. No more carbon footprint type of risks. So those are just 3 examples of risks that you cannot get covered in the commercial carrier market.
Yeah, very good points, Chris. But if you look here, you see operational risk inside the business, theoretically in your control. Very hard to insure all these in the commercial market, right? And then we see strategic risks that are outside your control. And these are things that can really upend your business. In fact, for example, the call that I was just on today, the business owner does international travel for sourcing. Kidnap and ransom is a very real risk, right? And being extorted. Supply chain is a very real risk for the person that I was talking to today as well, because they get supplies from Asia and they're constantly selling product in South America, Europe, and North America. So just think about that kind of supply chain, that kind of complexity.
Randy, did you see that question that just popped up?
All right, question. You can actually cover entrance by competitors, question mark. You can, not all the time. The key to an entrance by competitors policy typically is to be in a little bit of a niche space and define a geography that is your geography. So if you have a location, you can insure somebody entering that. It has to be well defined. It can't just be, hey, somebody started a business similar to mine. But if it's defined properly, that can be insured. Yes, good question. Go ahead, Chris.
No, that's it. I didn't have a question.
Yeah,
I just want to say someone was asking that question. That's all I was saying.
Yeah. When you think about entrance by competitors, I had a good friend. He ran a bunch of Fantastic Sam's haircutting places, and he had a competitor enter his market, Supercuts with $5 haircuts, So he didn't have a captive at the time, but he went to the bank account and got out some money and ran a marketing campaign. We fixed $5 haircuts. So anyway, he came out really well. So actually, sometimes you can turn a competitor entering your market into a positive, right? Okay, let's keep going. So, if you think about what we just described, businesses have a fork in the road. You can insure those underinsured risks or not insure them. That's a tough fork sometimes, right? And if you insure them, this is the conundrum, you insure them in the commercial market, you pay premiums, you don't have claims, all that money is a sunk cost, right? Gone. On the other hand, if you own your own insurance company, you pay premiums and you don't have claims, it's a sunk profit. It's money that you keep in your insurance company, you get to invest and grow. And we'll speak to that here in a few slides as well. So a captive structure looks essentially like what you see here, where a business owner or owners own business, own captive, right? Obviously, you see the ownership lines here. They pay premiums, transfer risk to their insurance company. It issues insurance policies back. And then that captive, in most cases, is going to get backstopped somehow. Normally, it's not left on its own, if you will. The captive, in many of our clients, we go out to the commercial reinsurance market, take advantage of the insurance license the captive has to shop wholesale, if you will, for reinsurance. Or Another thing that captives can do is pool risk, like you're going to see here, where they're sharing risk in a pool. And I'm going to come back to that in a few slides. But if you are an advisor to successful business owners, there's a lot of benefits for you as an advisor, because a captive is going to create assets under management. An insurance company is going to build reserves to be able to pay claims. And very often this is something that you can advise them on how to invest and grow. So it's a great opportunity for you to help your clients not only protect their business, but also create an investable pool of assets. All right. So we mentioned the importance of backstopping a captive or reinsurance. So let's talk about how that works for some of our clients. Many of our clients participate in a reinsurance pool that has 120 insurance companies in it, small and mid-sized businesses all over the US. And so their business pays premiums to their captive, and their captive shares, in our model, half its risk with a risk pool. So there's some risk sharing there, or co-oping, if you will. And so this is a huge win if you have a loss, because then you're going to get help from a lot of other unrelated third parties. So imagine you have a business, you have a $400,000 loss, and you have no insurance for that event, whatever it was. You just eat it, right? What happens? Maybe you lose wealth. Maybe you have to fire a bunch of people to pay for it. Horrible, right? On the other hand, if you own your own insurance company, like we see in this diagram, you file a claim for your loss. Third-party adjuster comes out, approves the claim after they verify it's real and everything's true. Then the business owner signs the check from their captive to the business for $400,000. The risk pool pays the captive on a reinsurance basis half the loss. So that's a huge, huge win, huge win. All right, so let's go through some cases, because what we shared when we posted about this webinar is the idea that I formed a captive, but then I had a huge claim in my first year. Now, we've had many clients that had a huge claim in their first year, and we're going to run through a few of those right here. Now, a few of our clients maybe had the claim in year 2 or 3, but nevertheless, the math is all the same, right? All right, well, let's start with a salt mine. And they had an insurance policy for mechanical breakdown. Now, this salt mine happened to be underground and had a gigantic conveyor belt that took the salt up out of the mine, and it broke down. That would be a very hard thing to insure in the commercial market, especially the business interruption that it caused, but it was insured in their captive, right? So they had a $650,000, not that million shouldn't be there, apologies, that was a typo, $650,000 claim approved, right? And the result was that the conveyor was repaired, but also while they were waiting on the conveyor, they had to buy salt from competitors to keep supplying their clients, right? Didn't want to lose their customers. And so there's a difference in price buying from a competitor and marking it up, right? So this covered that extra loss there too. So let's do the math on that. So it's a $650,000 claim, right? Well, remember, half is paid by the captive and half is paid by the risk pool. That gets you to 650. Well, had they taken 325,000, right, that went into the captive and simply had no captive and just paid the taxes on it, they would have had the ability to address that loss of 188.5, right? But because of the captive and the pool, the ability to address the loss is 650. It's a $461,000 swing on a client's ability to address an unexpected event. And that's mind-blowing. Just think about that. Let's cover some more. And this is actually a fairly recent one for us. We have a client that was in the courier, had a courier last mile delivery franchise, and they insured losing that key contract, that franchise relationship. In their first year, they lost the relationship. It actually was more than $1 million loss, but they were only insured up to $1 million. But that $1 million let them pivot to new business lines rather than just being completely wiped out. So it was huge. Let's do the math. You have $1 million claim paid by the captive and the pool together. Had they just taken that $500,000 and paid taxes, they would have only had $300,000, right? So this client was prepared to the tune of $700,000 more for this unexpected loss than they would have been otherwise. Here's another one, very recent. Dental practice closed during COVID, right? Business interruption and broad form property coverage. Their claim was approved for $350. Right now, the PPP loan did help them some, but they still had operating costs, lost revenue, a whole lot, as you can imagine. So the result, they survived COVID. They kept their staff, and then they sold the practice for a large profit after COVID. That was really smart, by the way. Okay, so let's think about that. $350,000 claim paid, 175 by their captive, 175 by the pool. If they had taken the 175 they paid to their captive and simply had no captive, paid the taxes, they only would have had 110 to address this crisis versus 350. So they were $240,000 to the better. Yes, Chris.
I was just going to make a point how if you notice the amount paid by the captive and paid by the risk pool is like 50-50. Actually, it's 51% by the risk pool. But kind of like going back to that question that was asked earlier about the IRS aiding captives, the IRS has come out with an IRS safe harbor ruling, which states that more than 50% of your risk has to be unaffiliated business. So that's one of the things that CIC Services is very proud of. We have a reinsurance pool, which is on $1. We share the losses or the reinsurance pool on $1. So this way it's a very legitimate risk distribution reinsurance pool. And that's an example of the CIC Services excellent corporate governance and setting up a captive the right way. Are you still there, Randy? So Randy might have froze right there. So I'm going to share my screen. So while Randy attempts to join us, but that reinsurance pool, so it's very critical that they're set up the correct way. And here's another example. The client was a community bank. He had a loss of a key employee and related expense and lost revenue. Again, there was an approved claim of $2 million. Randy talked about sometimes our reinsurance pool, the limits are always like usually $1 million or $2 million. There might be a few examples where the losses are more than $1 million. And again, with the math, the same thing. Basically, a $2 million loss, half paid by the captive, half paid by the pool. And the advantage and the difference is that $1.23 million. Oh, Chris can't.
Chris, I think I'm back.
Okay, go ahead.
Sorry about that. Yeah,
That's
let's keep going. Can y'all see that?
I can see your screen. Yes, Randy.
Yeah. Oh, we've got some more questions in the chat. Okay, a bunch of them. Wow. Okay, Chris, can you share your screen? Can't see it, Chris. Okay.
I was trying to share my screen when you froze, but you're back.
Sorry. Yeah, let's just keep going. Hopefully I didn't miss a message here.
I was just talking about the criticalness of having risk distribution, sharing risk with unaffiliated entities when you froze, Randy.
Yeah, absolutely. Okay, good. Yeah. Yep, good. Let's keep rolling here. So I'm going to go quicker now that you kind of see the logic and the math. This is a great one. We had a community bank. They're wonderful for captives.
Randy, we did that one.
We did that one. Oh yeah, nice.
Okay. When you're frozen, go to the next one. Yeah.
All right. We had a snowmobile performance part dealer, and they had a loss of key contract policy, $1 million claim. And they had revenue from warranty contracts that they sold, and they lost the opportunity to offer those warranty contracts. So it was a huge hit. So you'll notice, same math, $710,000 difference between having $1 million to address it with versus $290. All right. We had an insurance broker. They got that call that no one wants to get, which is, my wife, her brother just became an insurance agent, so I got to move the business no matter how good you've done. So they lost a huge account. They really were going to have to lay off staff, except they had a captive, and that captive gave them the money to survive and keep going and not lay off their staff until they could find more sales, right? The swing is $342,000. They would have only had 157 to address the loss versus 500. Huge difference. Another client, manufacturer, they had legislative regulatory change. So I think many of you probably remember when Trump put tariffs on goods coming in from overseas. Well, this affected them. And because they had to eat that cost because they weren't able to just pass it on to their customers, right? And so $230,000 claim to offset the impact of tariffs, and they were $163,000 to the good during that crisis. Okay. Another is import-export business. They had an administrative action because DHS Customs seized their shipment coming in. It was a $600,000 loss. They had an administrative action policy for government action brought against them or their business. And so they were $426,000 to the good. So they had a $600,000 claim paid. However, if they had just taken the same $300,000, paid the taxes, they would have only had a $174,000 to deal with this crisis. So you can see just how valuable a captive insurance company can be, especially in your first year, right? Okay. So the difference is really the sunk cost versus the sunk profit. And so a captive gives you sunk profits. Would love to go over the bank again. Didn't get Chris's explanation. Let's go back, Chris. All right. Sorry about that.
Both didn't get the explanation on what?
On the bank?
Okay.
I can tell you the story. So this community bank had a key employee that really drove their mortgage side, had all the relationships with the realtors. Now think about that. That key employee had a non-compete. Okay. In some states that's easy to enforce, in some states it's not. That employee jumped to another bank. They had $2 million policy limit and spent every bit of it to, one, litigate the non-compete and try to tie up the employee. But business was going out the door because the realtors were taking people to other banks for mortgages, right? So they had to litigate the non-compete, but also make up for lost mortgage revenue until they could work their way through it and try to get some of that business back. Does that make sense? Hopefully that answers your question. And that was just a specific case here. Now, you'll notice these numbers are a little different because they were a C Corp, so they were taxed at 21%, not typically the 40 that most have with 37 in state. And then nevertheless, the bank basically was $1.2 million to the good in the sense of they had $2 million claim paid. If they had taken that $1 million that was matched by the pool and paid taxes on it, they would have only had $770 to deal with the same crisis. Okay. Hopefully that answers your question. Looks like yes and thanks. All right, very good.
So I think Randy froze again. I hope everyone can hear me here. So basically, what happens to the assets in the captive that are not paid out in claims or expenses? The owner gets to keep everything. So Randy talked about that before. It's either a sunk cost if you just buy your insurance from the carrier market, the traditional carrier market, but if you form a captive, it's a sunk profit. The profit remains with the business owner. And taxation of captives, basically premium income is offset by reserves for losses. And I'm going to try to share my screen again. And Chris Steele, I hope you can see that. Taxation of captives. Hope everyone can see that. It's a little tricky when Randy, when his internet dropped him. But premium income is offset by reserves for losses, also known as claims. The resulting underwriting profits, along with any investment earnings of the captive, are taxed at ordinary tax rates. And you back, Randy?
Yeah, why don't we just go off your slides? We had a tornado come through here last week, and it's just been spotty internet for a while. So you screen share, Chris. We'll just keep going.
Right. And so the small captive insurance, Congress adopted the 831B election of the IRS code in 1986 to strengthen U.S. small and mid-sized business. Captive insurance companies elected to be taxed under the 831B are taxed at 0% on the underwriting profits if premiums are received at $2.65 million or less. And that's also gauged to inflation. It was 2.45 in 2022. It's 2.65 million in 2023. Maybe it's 2.7 or so in 2024. Also, most investment earnings are also taxed at ordinary rates. So enterprise risk, you want to take that, Randy, right there? Are you there, Randy? Oh, you froze. Okay. So here's an example. Randy froze again, that tornado. Here's an example of a business, a same business, one with enterprise risks insured in it. So the business without the enterprise risk, the reserves are 5.9 million, and with the enterprise risk at 10.7 million. And the difference, as you can see, are all these lines in the green box. So these are all the additional lines that the business owner is able to insure with the same amount of after-tax assets as if he did not form the captive. So that's the advantage. You get more coverage at the same cost. So here's an example of the financials. And if the informal self-insurance, if they insured those enterprise risks, but they did not form the captive, basically they'd be sitting on $5.9 million of accumulated loss reserves. But the same scenario, if he formally insured it via a captive, he'd be at $10.7 million. So that's a difference of about $4 million. That's a big difference. And the last one is captive with hedging. That's proprietary information that we can share with you, where we show you how to take the profits out on a later date at the most tax-effective manner. And this is with the annual distributions. So the informal self-insurance without a captive, basically you'd have $710,000 of annual distributions. With the captive, it'd be $900,000 annually. And the captive with the hedging strategy that I just alluded to, they would bump that up to $1.4 million. So the benefits: stronger business model, improved risk management, cost control, insurance profits, asset protection, wealth accumulation, advantageous tax treatment. I talked at the beginning of the webinar, where my 35-year career as a regulator, how I saw how critical it is to have cash flow, liquidity, and earnings. And I'm very pleased to report that formalizing your self-insurance via a captive aids all three of those critical components for businesses of every single size. So basically, you get more insurance and more money. So that's a good thing. It's not like you're getting more coverage and it's costing you more money. You're getting both. You're getting more coverage and more cash flow, liquidity. So, and what's in it for you for the trusted advisor? You insure. We work a lot of times with CPA firms, financial advisors, attorneys, and brokers, insurance brokers. We show them this strategy where their clients get more protection, more assets. And so that adds a lot of value to the trusted advisor when all of a sudden they recommend this perfectly sound strategy of a captive insurance to their clients. So like Randy stated, we are going to send a copy of everyone who had this who was attended this presentation, who signed up for it. We will send you these slides. There's our contact information. If you want any additional information, we'd be more than willing and happy to set some time up to discuss how captive can benefit your business. I'm going to check the chat box. I don't see any questions at this point. Oh, I do. Hold on. Okay, chat. Let's see. Lots of diverse businesses have captives. Is there any? Okay, let's see. Is there any particular type of business not conducive for captives? I would say no. Well, please state the profile of a viable prospect, including the minimum amount of premium or gross sales of a given business. So I would say the minimum annual gross revenue where the economics starts to make sense would be $5 million of annual gross revenue. And let's see what else. Going back. Okay, good. You can see. As we're looking at this process, please walk through the taxation at the beginning and when the captive may issue distributions to participants later in the process. So it is a legitimate insurance company. We don't set up a captive insurance company. It's not going to be a piggy bank for the business owner. What I mean by that is you don't put the money into the captive and say, oh, I'm going to pull it out. It's going to be run like a legitimate insurance company because it is a legitimate insurance company. But usually I would start to say at the end of year 2, definitely going into year 3, there are excess surplus funds in the captive insurance company, whereby we then approach the regulator and we say, oh, this captive would like to make a dividend from their captive and pull some of the money out. And most of those regulators can give us that approval within 24 hours. And it says walk through the taxation at the beginning. So in a nutshell, I'm not a tax authority, but if a company elects the 831B election, the premiums paid to its captive. So say, for example, most of our clients are in the 37% federal income tax bracket. Throw in, say, another 6% for a state income tax. That's a combined tax rate of 43%. So if a business owner formed a legitimate insurance company, elected the 831B election, and paid $1 million of premiums towards his captive insurance company to address his legitimate insurable risks, him being that combined 43%, that business owner would be able to deduct that $1 million from the business owner's taxes, and thereby basically saving them a combined $430,000. Going up to the question before that, let's see. Okay, Randy talked about the bank. And then going down, our fee structure, right at the end, there are minimums, but basically for a smaller captive, and a smaller captive might be premiums in the $300,000, $400,000, $500,000 a premium. That fee is approximately $50,000 per year. Our business clients do not mind paying that because they find between the enhanced risk mitigation strategies plus the tax savings is more than enough to pay that. So it's always a net positive for them even after the fees. And that slide that Randy showed before about this informally insuring your business, formally insuring your business via captive or with a hedging strategy, that shows all fees in, the cost of captive management included. So it's always a net positive. Randy and I gave a webinar a couple years back that inception from 2005, when CIC Services started as a captive, to today, that 99% of the business owners, captive insurance companies have gone on to be a proven second profit center. Can you actually cover entrance by competitors? So Randy said you can insure against entrance by competitors, but it has to be tightly defined. It just can't be general. Let's see. I think we actually answered all the other ones. Can't see your screen. Can't see Chris. Good now. Randy talked about tax issues. Like diverse business. Let me see. Align. Not conducive to. Okay, so I would say captives are basically run the gamut of all industry types. And I'd say the one business, if they don't have legitimate insurable risks. So our process actually is we have the very first step after the client fills out the pro bono questionnaire. We run a customized model to show them the risks that we think that would be covered. But if the client wanted to move forward, the very first step would be a risk assessment by a third party risk assessor. And if the risk assessor, there are no legitimate insurable risks. So there's sometimes they might not have any employees, they might not have any services, but we have come across a few where they really don't have enough legitimate insurable risks. Randy, you're back on with us?
Yes,
Okay,
finally.
good.
As I mentioned, tornadoes came through a week ago and I think they've just been trying to fix the lines around here, so apologies.
So we had like 16 comments in the chat section. I believe I got through them all. So it does show good participation by the participants, that they're actively asking all those questions. Always a good sign for the presenters. We like it when we get a lot of inquiries. And I mentioned how we're going to email this slide deck to all the attendees, and that if they have any additional questions and would like us to look at any of their business owner clients, we would love to do that.
Yeah, or if you are a business owner and are thinking about protecting your business with a captive, definitely reach out to us.
So seeing no additional questions, I would like to thank everyone for their attendance today. Have a blessed rest of the day, and we look forward to hearing from you in the future.
Everybody have a fantastic day.